Good afternoon, everyone. We're going to start in just 1 minute. We're letting a few more people log on.
Hey, Mike, we see your calendar reminder that you're having a webinar now.
Me?
No, Mike Carnathan.
Really?
Yep.
Oh, I see it. Mike and Mike webinar.
Well, I'm glad I got that reminder up.
I know. I'm glad you're here.
Right. I mean, if it wasn't for that reminder, I wouldn't be here.
Hey, good afternoon, everyone. Welcome to the Mike and Mike show. This week's webinar is entitled What We Know or Think We Know About the Economic Impact of COVID-19, Part 2. And we're so happy to be here with you and really grateful that you're willing to spend an hour with us. Mike, don't disappoint them. The first imperative. So hopefully we're going to provide you some really great information. If nothing else, you'll get a few chuckles and maybe be entertained for a little while. But before we get into the data, because you know we're about to bring the data, we want to acknowledge that we're using the GoToWebinar platform. Throughout this webinar, you'll be allowed to submit text questions or comments into the GoToWebinar window. We're going to hold all of the questions till the end. If you drop off, we'll still try to answer the question, even if you're not available, for the good of the group. And again, we're not going to turn the mics on this time because we think that's just too much. But Mike and I will stay with you as long as you want to ask questions, and we'll do our best to field them. So with that, I'm going to move my little text screen out of the way. And Mike's going to click to the next slide to get us started.
There we go. Let's get us started off, Mike A.
Wait, isn't this your slide?
You're the one who put it in.
All right, so I did like this image. Last weekend, one of my friends had that mug, and I thought it was completely appropriate to set a tone for this webinar. That I think we all can agree that we miss just precedented times. And I think we're moving away from using the word unprecedented because now doing this second webinar, we know we're over 6 months into the shutdown here in Metro Atlanta. So we're going to take stock of that, and hopefully I'll be ordering this mug myself for use here in my office in my home in Decatur. So next slide, Mike.
Yeah, and so before we start talking about the economy, and you've heard me say this several times before, and I say it every one of these presentations I give, we can't really talk about what's going to happen with the economy or what's happening in the economy without talking about what's happening in the public health side of things. And so that's why we put out this report every single week. That's why it's called the weekly report, that we sort of just look at not only COVID cases, COVID deaths, but we also look at economic related indicators like unemployment insurance claims, new job postings, and just overall time spent out of home. And for the most part, what we've been seeing in the public health side of things is, you know, mostly good news. But there's always a but.
There's always a but. And on the right, you see a line chart from our COVID tool showing you the 10 county areas, 7-day moving average trends, that Atlanta Regional Commission area in blue-green. And Mike and I were having a discussion like, we've already been through 2 peaks, but when you really look at this chart, we thought we were in a peak back in April. But the reality is that the real peak was going to come much later for us. And of course, through late July and the first part of August, we were really at the true peak so far in COVID cases. And since then, it's fallen dramatically. And so I put the map in on the left from the New York Times just to show you those case trends. And if you look at Metro Atlanta, you'll see really one of the weaker color oranges to show that we have trended down. We're bouncing around a little bit now. We haven't seen that trend continue downward. We'd love to see it go below 400. So next couple of weeks are going to be very interesting for us as we watch these case rates change over time. But Metro Atlanta, like Mike's saying, there's some real positivity, not to use a COVID pun, with our recent trends. But again, Georgia, relatively high rates compared to the Northeast and areas that really have much, much lower case rate data. But there are lots of counties across the US that are in the red.
Right, and you know, yes, cases are going down, but one of the things that we have noticed in the past month or so is that testing has gone way down too. And so, you know, this is something that we just stole straight up from Amber Schmidtke. You know, she puts out a daily blog, and we rely on that a lot. We think the world of her.
Absolutely.
But what her data is showing from the testing side is we've, you know, in mid-August, we're averaging about 1,200 tests per 100,000 population. Now we're down to about 600 tests. So you'll see that, you know, testing has gone way, way down. But at the same time, Mike, positivity, that pun that he tried to use earlier, has really leveled off. And so it's not, you know, you can do the math on this. If you apply the same positivity rate to a higher testing rate, well, that might give you a truer case count.
And you stole my slide.
I know I did.
And
I'll
if you
make
go
it up
back
to
to
you.
that just a second, just as a reminder, go back one, Mike, that, you know, we really want that positivity rate to go below 5%. That's the generally accepted goal, that you can get your transmission rates under control if you're testing a lot and the positivity rate is below 5%. So we're doing better in Georgia, but it's still not near as low as we would want it to be.
That's right.
Slide stealer.
Okay. All yours.
Wait, I thought this was yours. And again, we put this in for everyone just so you could be aware. I know many of you probably go to the COVID exit strategy website, and again, we're relying on Dr. Schmidtke with the hospital admissions rate. And so one of the things that Georgia's probably, compared to all the other states in the US, really having the most problems is actually in the number of people that are currently hospitalized. So the hospitals are managing that, I think, really well, but the fact is the rate per million, only Mississippi as a state has a higher hospitalization rate right now across the US. So this is clearly an issue for Georgia right now, the number of people that are in our hospitals. Hospitals are managing it. Nobody is really beyond capacity, but again, a lot of people are very sick in Georgia and are having to go into the hospital. And all kidding aside, we couldn't take that more seriously.
And so one of the things when we, again, obviously we can't talk about the state of the economy without talking about the state of public health, and sort of the intersection between those two, and I've mentioned this before too, is really just trying to capture human behavior. And because that's how, you know, we're either going to react to the virus or we're going to react to the economy, and sometimes we react to both. And so here's a slide that sort of looks at both, and this is a complicated chart. You know, I like to make complicated charts, but what you're looking at is, if you look at the dark blue line, that is the percentage change in time spent away from home compared to normal times, and that's like January. And that's on the right axis over here. So you'll see in, you know, in early March, late February, things were more or less normal. And then the lockdown started happening, businesses started closing, and then all of a sudden, we started spending a lot more time at home. At the same time, the light blue line, these are new COVID cases per 100,000 population, and it's being tracked by the left axis. You'll see those COVID cases go up. time spent away from home going down. And so that's a rational reaction to COVID cases. Now, as that April peak sort of passes into May and cases begin to stabilize, even go down a little bit, well, we start spending more time outside of the home. And so you'll see that kind of tracking consistently until, again, somewhere around, the mid-June, late June. That's when those cases, that's when that second peak happens, and the cases skyrocket. And then you'll see, that's when we, that our time spent away from home really levels off at that point until, again, sort of the end of August. And you'll see cases going back down again. And you also see time spent away from home ticking up again too. And so when we talk about human behavior, these are the sort of data that we're looking at to see how, with the virus, with what we're doing in the economy, how are those two interacting with one another? And another way, and it really all comes down to human perception. And so, there's this survey that Ipsos Axios does periodically. They've asked us at several points during the pandemic. And essentially it's asking, how safe do you feel to returning to, somewhat normal economic activities? And the simple fact of the matter is the majority of Americans, and this is a national poll, the majority of Americans still feel somewhat unsafe returning to normal activities, things like, in-person gatherings, dining at a restaurant, returning to your normal place of employment. And, with these type of numbers and with that perception that we're still somewhat at risk returning to normal economic activities, well, that's going to obviously have an impact on how the economy recovers.
And so if you're thinking about the previous slide and returning to work, our Georgia Commute Options program that ARC manages through our Mobility Services Group just did another survey in August of employers and their perceptions around remote work. And I pulled this hot off the presses for this webinar today because I thought you would really find it fascinating. And so I know this is also a complicated slide. The graphics are beautiful and there's a lot of great information on here. So if you look on the far left, basically what you're seeing is survey results of interest in working remotely and the number of days the people surveyed thought they would want to work remotely. And so before, only 3% of the people surveyed thought that 5 days a week of remote work was something they wanted to do. And so if you look at that number now in August, it's 66%. So that's a dramatic change in people's thoughts about whether they can do remote work or not. And again, 60%, and that's that red bar now, are saying 3 days or more a week they'd like to work remotely. So that's a big change in the pattern for us, for those workers that can work remotely, that they've really bought into that idea. There are some challenges. Next slide. So if you think of the negatives associated with this, and we're comparing April to August, really very similar results in commuting, quality of life, and productivity. But down at the bottom, and I think we all know this, we are all struggling to unplug from work. I was talking to our chairman and recently, Carrie Armstrong, and it's a 24-hour world now with email and text and these webinars that we're really seeing this. The highest rates of negative survey results were around this idea of struggling to unplug. And this is something we've got to work on long term, literally as a society. So let's fill that out a little bit more and make it generational, because we love to talk about generations, especially through memes now and social media. But when we characterize these survey results by age groups, you can see that millennials reported struggling more to stay motivated, that they were more distracted with kids or pets at home. Only Generation X, which is Mike and I, we're continually worried about our own health of the organization and our work performance. But again, sadly, one of the things when I first read this, do you feel lonely? And, over a quarter of the millennials that responded to this survey said, yeah, absolutely, I feel lonely. And as a result, they're thinking about the things they're missing, like exercise and relaxing, and their morale is lower as a result. And it would only be rational to recognize that they also feel less productive with all those other conditions listed above. So again, very much a challenge for us. Boomers in the survey response, and I would imagine we had fewer boomers in this survey, but generally more resilient in the way they perceive how things are going. And you'll see on this last slide related to this from our GCO survey, if you look at the boomers, man, they think they work better at home. 65% say, I'm going to do the work as well or better at home than I would at work. And that's only 41% for millennials. And Gen X, Mike and I, again, we're in the middle of the pack where the majority of us do think we're actually better at home. So big generational differences. And if you're someone on this call who's supervising people, you need to be aware of these perceptions and making sure you're taking care of your people.
And it's a somewhat surprising result too. Millennials have, grew up with technology, grew up being more, just being more comfortable around digital technologies. But 25% of millennials would actually prefer to do their work at a workplace. And so these are, again, as Mike's saying, it's these, we're moving to a teleworking world, and, understanding these differences based on the age composition of your workforce is pretty important.
Yeah, next slide. So I just put this image in because I like this image. It's a beautiful 3D rendering of population density across the globe. I can't think of a bigger trend than that, but you can see the relative density comparisons. This is just a little mental break for you before we do get into these big trends. And of course, we're going to put this deck, like we always do, into the GoToWebinar window here in a few minutes after we poll you. So click on this. Mike and I both love Visual Capitalists. We realize that Doug has found Visual Capitalists, Doug Hooker, our executive director. So he's often sending us links to Visual Capitalists now. It's a great website, wonderful graphics, and you're going to see a couple more slides where we built that in. Now, I wanted to begin the big trends with one of the few things that I think is a relative positive given these circumstances. These circumstances are terrible, but I was reading The Economist, and I came across this on graphic detail, and I think it's fascinating. So with the lockdowns and people wearing masks, in the Southern Hemisphere, the flu season has been fundamentally different. So if you look at the orange lines, those are previous year flu case rates by country, and you'll see the red line is what happened in 2020. So you can see that in most of the countries, that red line doesn't go up at all, which means because of the lockdowns and mask wearing, they were less exposed to other people. And as a result, the flu season has actually been better in the Southern Hemisphere. One point of positivity associated with this pandemic.
All right, so now what we're going to do is we're going to do a quick poll, and we're going to ask Jared or Mike A, the poll master, to open up the poll. And
poll master.
Are you the poll master?
I'm gonna be the poll master. I'm gonna hit launch here in
Mike A is your poll master for this afternoon. And the simple question is, when will the U.S. reach 25 million inoculations of an FDA-approved COVID-19 vaccine? Now, this is going to be an FDA-approved COVID-19 vaccine.
That's FDA approved.
There is your.
All right, so it's up. Choices. So everybody right now, click on the one you think is most correct.
We'll give you a couple more seconds.
Can you see the results in the window, Mike?
I cannot.
Okay, I can see poll in progress. All right, we're going to give it a few more seconds. And I'm going to hit close in 5, 4, 3, 2, 1.
Okay.
And then, wait, Jared, how do I share the results?
Some poll master you are.
I know, I totally botched it. So, all right, on this call, most of the people think it'll be between October 1st, 2021 and April 1st, 2022. And a slightly less number, 37%, think after April 1st, 2021, but before September 30th. And so let's get out of that now. So 56%. And then this is a website called Good Judgment that takes forecasters and gets them to forecast on a regular basis many national societal issues and then summarizes the result. So I pulled this morning, and you can see these experts, these highly accurate forecasters, and I hope you click on the links later, are saying that 54% think it'll be between October 1st, 2020 and March of 2021. So literally the numbers are almost flipped compared to the way everybody on this call was responding. But this again is one of those fundamental issues for us going forward is, what's most likely to happen with respect to a vaccine, because when you're looking at the surveys, the national surveys, and what Mike has already showed you about the lack of confidence of returning to normal behaviors, really a vaccine is the best hope we have to beat this in any real near term. So again, these super forecasters think by March 2021, 25 million inoculations will be done. I'm with the people on this survey. I think we're going to struggle to get that done so quickly. But what I did was I put the chart in from Good Judgment to show you that red line and how it's changed over time. It's actually falling. And then that orange line, a gold line, is picking up a little bit. But you can check this daily to see what they think. And these forecasters are continually revising this literally every day. So this is a fun website that I've been checking to get some feedback about how we're doing. All right, Mike. Okay, another really big picture point about what's happened during the COVID crisis is something I found from McKinsey. I love to get the McKinsey emails on some of their research. If you haven't signed up for that, I think you should. But they call this short one the Quickening, and I really don't like this name. So the Quickening from McKinsey had, and you want to click now, Mike, this chart, and this chart I think is absolutely fascinating. And he clicked too quickly, man. You killed my joke. But if you look at, all right, hold what you got. Hold what you got.
Pretend you didn't see that.
No. So, we have been talking on some of our presentations about e-commerce and how well it was penetrating really the retail market. And it's been creeping up steadily since 2009. But in the last 3 months, Q1 out to Q1 2020, explosive change. And I think McKinsey's absolutely brilliant in the way they use this idea, 10 years of growth in 3 months. And they do this with other data points as well. So this is a dramatic change in the economy of the United States. But the Quickening, not so much. Now Mike can let the image come up, because if there's one movie that hasn't aged well, and they actually made a sequel to The Highlander, which is one of the worst movies ever made. It's got a 0 on Rotten Tomatoes. The Quickening is maybe not the best idea. That said, McKinsey has given us great information about what's happening here in the United States, and please pay attention to this change. We all see it and feel it in the way we've been ordering online, but this is going to have long-term ramifications for lots of things we think about at the ARC, like freight movement.
Yeah, and I'm not sure I ruined that joke too much, so don't feel too down.
I'm trying, man. I'm trying. And then the other big trend that I want to make sure, everyone was thinking about is really that Amazon chart. And this is market capitalization. And the chart, I set these to be the longest range possible for each of these companies. But Amazon has really gone from, $600 billion in market cap back at roughly the start of 2018 to $1.6 trillion. And that's a big, big change, right? And it feeds off of that e-commerce slide. And then I wanted you to see some of the other classic companies at the bottom, like Exxon, 173, but you can see that downward trend in their market capitalization. And those of you that are really into the stock market, and Mike and I aren't actually, I just think this is a great way to show where money is moving, where money thinks it'll be the most successful is this market capitalization chart. So Walmart, 400 billion a quarter. Walmart still has more sales than Amazon, but again, a lot less capital to work with. GM, 45 billion. A comparison company, Tesla now, $307 billion in market capitalization. And again, not the same company as a GM really, but trying to build 500,000 cars this year is Tesla's goal if you stay up with the news. The next two, NextEra Energy, I hope you Google it. They own Florida Power. They're a committed green company. They have 5 nuclear plants, so I'll put that in quotations, but they do lots of solar and wind farms, and you can see money moving to NextEra Energy in really a substantial way. Consistent curve, fell a little bit at the start of the pandemic, but now back up. And America Homes for Rent is a company Mike and I learned about a few years ago coming out of the last recession. They specialize in buying single-family detached housing and renting that housing out for the long term, not to flip it, but they're maintaining it. And it's one of a couple large publicly traded companies, and you can see lots of money flowing into American Homes for Rent. So these just capture some of the ways our economy is changing. And that America Homes for Rent in particular is one we were paying attention to. We're at record levels of home equity in the United States right now. But again, people have been losing their jobs. They're going to struggle to make payments on their mortgages. So companies like American Homes for Rent are going to be well positioned to take advantage of that if the crisis gets any worse than it already is. So this is a challenge for us. Go ahead, Mike. Okay, and so another big point, and I read this in the news, and I thought it was absolutely fascinating again that Amazon is trying to increase its real warehouse space by 50% this year. And so I just wanted you to see that growth in the chart on the right, their physical presence and how it's changed each year. So they had a big year in 2017, slower in 18 and 19, but back at it again. So when you have $1.6 trillion in market capitalization, you can absolutely expand. So we're always reading in the news now about Amazon doing this, Amazon building this, Amazon's hiring 1,000 people. Well, it's a result of the slides we've already showed you, and we don't expect that trend to change. E-commerce is going to impact the way we get our goods and services because they're only feeding what we've had to do as a result of this pandemic. Literally.
And then the last couple of slides are really just kind of showing you that there are distinct winners and losers in this economy. Yes, there's the stories of Amazon's and some of those other firms that we looked at in the market capitalization slide, but we keep seeing headlines like this. This is sort of the latest one of those, and it seems like every week we have some new study talking about how many of these business closures are going to be permanent. This latest one is from Yelp, and so they're saying about 60% of business closures are now permanent. And so that gets us thinking, okay, well, what does that really mean for the long-term recovery of the economy? And that's going to bring us back to our poll master, who's not much of a master of polls, but we are going to ask you a question once again to get your take on what you think, what letter you think the recovery is going to take.
Yeah, and Mike is much more into describing recoveries by letters and shapes, but take a second to look at this. And I tried to describe the answer set to give you an idea of the year you think we're going to get back to our previous peak in employment. And again, ideally, we'd like to have a V-shaped recovery, V for victory. And so that would mean we'd get back relatively quickly. What we don't want right now, we're really at risk of, is a W-shaped recovery, right? Where we're recovering, but then we fall back into recession and it takes us a little bit longer to come back. But then an L-shaped recovery obviously would push us way out past 2023 realistically before we get back to pre-employment peaks. So I'm gonna turn this on. You tell us what you think is going to happen. All right, launch. Here comes the launch. All right, it's live. All right, the number's bouncing around.
It is. It's bouncing around pretty.
Don't tell them. All right. 73% have voted. All right, just a few more seconds. Let's get 80% voted. All right, we need 5% more, 4% more. And I'm about to hit close.
Like we're like an auction or something.
I know. This is fun though. You get to decide. All right, I don't think we're gonna get above 78%. So I'm gonna hit close. And then, oh, see, it pops up. I didn't do a thing.
I did that.
No, you didn't.
I hit share. I hit the little share button.
Where do you even see the share button? Oh yeah, sharing results.
Again, our poll.
All right, very, very few people think we're going to get out of this quickly. The largest number of people thinks it's going to be a U-shaped recovery out to 2022. Just behind that is a W-shaped recovery. And then 23% think an L-shaped recovery. So let's hide that now.
And what you're looking at is the result of the survey from the conference board. That's a think tank that analyzes economic trends, and they're right with folks on this webinar. The majority of folks in the United States thinks it will be a U-shaped recovery, and second place is an L-shaped, third place is a W-shaped, and then in last place, and you know, again, at the beginning of this pandemic, most economists were thinking of a V-shaped. That's clearly not in play now, as you'll see that very few of the folks who responded to this survey now think that a V-shaped is even possible anymore. And so if the U-shaped recovery comes true, again, we're looking at 2022 before we get the economy back to something what we would consider normal. And then later on, we're going to talk about a different letter of a shape that this recovery may take, but we'll talk about that later.
Yes, we will. Mike, why don't you take this one?
All right, I will.
I know my letter's on there, but
it's okay. I'll take it. This is the latest Fed projection. And really what I've circled is just kind of showing you how, I guess, more optimistic the Fed is compared to what they were thinking of in June. And again, you know, look, economists, you know, believe it or not, they're human too. So they have to react to the same type of cues, the same type of perceptions that we do. And they made this projection in June. Cases were skyrocketing. And so they had a much more negative perception of what was going to happen by year's end than they do now. And, you know, so with cases going down, Fed's optimistic. Fed's a little bit more optimistic about what the change in real GDP will be by the end of the year. And they're a little less optimistic about the longer term recovery. And so, you know, this sort of portends kind of that U-shaped recovery that y'all just voted on just a little bit ago.
Yeah, there's portending.
Oh, wow. Here's another take. Here's another take. This is from Oxford Economics, and this is, they sort of teamed up with McKinsey, and this was also done sort of, early June, mid-June, and this is a pretty pessimistic forecast. And really what you're looking at is they're looking at two scenarios, a virus contained scenario, and that's that little white dot, and just a muted recovery scenario, which means is the virus is winning, and that represents the black dot. And so they give you a range of how the economy will recover sector by sector. And so, in the worst case scenario, according to Oxford Economics, we might be talking 2025 or later for some key sectors in the nation and in Metro Atlanta. And so, again, they call economics the dismal science for a reason, because, the forecasts are all over the place. But, just to let you know that, we still have a ways to go before we get back to, anything approaching normal economic activity.
Yeah, and we really like that slide. I think it makes a lot of sense. And keep rolling, Mike.
Yeah.
And, wait, Mike, let me tell everybody, if you look in the chat now, I put a link to the deck. Okay. Since we're done with the polling, because we didn't want anybody to cheat on the answers.
Yeah, we have lots of integrity with our polling here. So this is another look at the economy, and this is looking at, again, Conference Board. They have a dozen or so of leading economic indicators, and they're listed over here, but you'll see, in June and July, that index really rebounded. Of course, it rebounded from a lower base, so a higher percentage increase. And you'll see it's just kind of, things are improving. It's lurching forward. But one point that I want to make here is, look at December 2019. Look at January 2020. That's something that we tend to forget, is that before the pandemic hit, the economy was already slowing down a little bit. Now, the economy has been supercharged for years, so one could expect it to slow down a little bit, but this slowdown was occurring before the pandemic hit. And obviously, when the pandemic hit, it just put it into just supercharged mode.
And along those same lines, we wanted you guys to have Moody Analytics back to normal index. And this is the real point. And the slide that follows this, we're going to fill this idea out. So we're going to go through this one quickly. But, if you look at this index that Moody has published with CNN, we really have been hovering now at around 80% for almost 3 full months now without any real uptick or any real downward trend. Go back just a second, Mike. Sorry, if you can. So take some time, if you can, in the future. I want you all to have the chart in the upper right just so you can see what's in that. And this idea of cross currents is critical, right? Some things are going better, some things are going worse. One of the things that's most depressing is this hours worked has actually been in decline in the last week and the previous month as well. So people are eating out more, but people are working less. And so that's why we're not getting a positive movement. We've got some things going poorly and got some things going well, and they're canceling each other out. So if we go to the next slide, I think everybody that knows us know that we really like Mark Zandi, and I read his stuff regularly. And I think he writes very, very well in the sense that he's efficient at getting at the heart of the matter. And so, retailing and housing are recovering. Consumer spending on many services is back to normal. Businesses are trying to hire. But the thing that we're going to talk a little bit about in the Metro Atlanta data is the fact that layoffs are declining, but they're still way beyond normal layoff rates. And it's taken a lot longer than Mike and I thought for those layoffs to decrease. So we're hiring, but at the same time, we're still laying people off. And this is critical because then you have to start thinking about what that means for federal stimulus, given that, you know, those layoffs have not really gone away in the U.S. economy or Metro Atlanta. And that unemployment outlook in the bottom right, that rate forecast, if you look at it, it hasn't changed, which means they know that the unemployment rate, there's no miracle coming. They've been very consistent in their forecasts related to what's going to happen to the unemployment rate, as they do new forecasts every month at Moody's. And that's critical for everyone to be aware of. Georgia is a state doing pretty well on the opening, but again, not going much up or down, just sort of moving sideways, as Mark Zandi likes to describe this as, where, you know, for me, it's a sailing term. There's a lot of leeway. The ship is not going completely straight right now towards economic recovery.
Yeah, and so, you know, it's that notion I was talking about earlier, you know, with how humans are interacting with the economy. And, you know, if we're bouncing around at 80% of economic capacity, well, that's just in any scenario, that's bad. And so, you know, that's, again, comes back to the point, you know, the virus is going to dictate how we end up recovering in this economy. So let's look at some numbers. So, you know, this is the latest. So this is as of August. And you'll see that we're adding jobs that, you know, we had that horrible month in May. Worst month, worst economic news ever. And that was May 8th, because I remember it because it was my birthday. That's when the news came out that the national economy lost something around 22 million jobs. And this is looking at Metro Atlanta. So you'll see that we're, again, lurching back. But again, you know, what this amounts to as of August is we still wiped out about 4 years worth of job gains.
And, you know, the latest BLS quarterly summary came out, and those summaries, the links there available to you, summarize the largest metros and how their, you know, their employment performance has been. And it's hard for us to make a chart. I had to change the word growth to decline to really fill this chart out, because this pandemic has meant that every place has lost jobs. And Mike and I have to acknowledge, you know, Metro Atlanta, really compared to the Northeast and San Francisco and Los Angeles, the job loss has been dramatically less year over year as of June. So we're doing less bad, but it's been horrible for everyone. 5.5% job decline is a terrible impact on the people here in Metro Atlanta. That said, you know, we hope that those jobs will recover quickly, and why we're interested in the recovery. But you can see again, generally the places that were least restrictive have experienced the least job decline, and that's something we have to acknowledge as a result.
Yep. Now, if you look at the long view, the reason I put this in here is because, you know, economies wax and wane all the time. And so if you look at this longer view, this is, you know, starting back in 1990, so a good 30-year view of this. Yes, that little downturn, well, it looks little here. That big massive downturn is it is the worst downturn that we've had. But just compared to the long view, you know, this is something that we're going to recover from. You know, and that's what ARC specializes in, is taking that long view. And so, you know, this chart's really here just to say, you know, this too will pass. We're just in the middle of it now, and it's not going to happen as fast as we want it to happen.
And if you think about this idea of cross currents and being sideways, leeway, this chart will really fill that out. I think we all know leisure as a sector has been particularly impacted. We're going to talk about that in a little more detail in a few slides. You see retail up, but professional and business services, you know, often people that can work remotely, the job declines have been dramatic as well, minus 5.2%. So not many bright spots in the sector analysis for this, and that's very different from previous recessions. And I know there's Tom Cunningham and some of the economists are on here. When you look at diffusion indexes, it's been particularly brutal. But leisure, arts, and entertainment being particularly impacted. And this is relatively recent data as of August. So,
right. And that's something that that surprised me as well is, we think that, the white collar worker, which the white collar worker overall is doing fine, but that's where white collar workers are mostly concentrated in is this professional and technical sector, but they too have been feeling the pain in this economy. Now, as Mike said earlier,
to follow based on income.
Right. And then as Mike mentioned earlier, look, the layoffs are declining. Here we're looking at initial unemployment insurance claims. They've been declining more or less pretty steadily since, that first initial shock in early April. There's been a little blips. Of course, there's that blip in early July, once we, really started realizing what we were dealing with the virus. But even since then, we've seen a steady decline in layoffs.
I'll go back to that though, but it's scale, and I don't want to lose sight of this. That 25,000 number in any other period in U.S. economic history would be a horrible number by itself. You have to really look to the far left of March 7th to see that normal number, very much around the 2,000 mark. So we're still, easily 10 times higher than we would be in a normal month for layoffs. So we still got a long way to go.
No, that's right. Thanks for pointing that out.
And then if you look at local government revenues, and these are by month, so the colors change. The dark blue is April, the light blue is July. And you can see that many of our local governments now, their year over year change, so this would be July to the previous July, are above the level they would have been in normal economic conditions. So Rockdale, Henry, Cherokee, DeKalb, Douglas, all having higher revenues in July of 2020 than they would have had in July of 2019. A place like Fulton County, which is much more dependent on revenue from tourism and travel and business travel, you can see recovering much slower than the more suburban economies that aren't so dependent on that type of revenue. But again, most of our local governments saw, and this is a positive, better revenue in July. We're still waiting for Fulton to catch up. And it's going to be a while if people don't feel safe to travel.
That's right. And now one of the things that we need to discuss is, that there was the PPP program, well, the Paycheck Protection Program, affectionately known as PPP. And we did kind of crack at that data to take a look at it. And this is looking at for Georgia, industry by industry, and this is just total number of loans per industry. And this gets back to that professional, scientific, and technical. I mean, it's a large industry in Georgia, so it was going to get a sizable chunk of those loans anyway. But looking on the face of it, most people are thinking, oh, okay, well that sector, that's white collar, that's powered by digital technology and work from home. But that sector received a lot of help. And you'll see the other sectors that you would expect too, like other services. And this is just a very diverse sector that's really made up of a lot of these high touch industries or high touch occupations like nail salons, like hair salons, massage parlors. So those were completely shut down. Those were the first to shut down and the last to reopen. You also see, food and accommodation total loans going to that sector because we know that was a hard hit sector as well. Now here's a second way to look at this. So here I normalized the number of PPP loans by the industry size. So the number of by job. And you'll see again, other services is popping out. And again, these data are for Georgia. And so you'll see the importance of the agriculture industry in Georgia. And so you'll see that they received a pretty robust share of these loans, when you're normalizing it by job. And then you see places like, retail, and really like real estate, which, at the beginning of the pandemic, we thought real estate was going to take a hit. So that sector really took advantage of these loans. Continuing on with PPP loans, we can also look at the distribution of them. And so here's one story that shows if you normalize these PPP loans per the number of businesses in each zip code, you'll see that the south side of the region, these zip codes, have the highest amount of PPP loans per business. And remember, if for those of us who've seen, for those of you who've seen us present, maps and show you all the kind of the spatial distribution of socioeconomics in this region, this map should look familiar. And this actually tells a pretty good equity story in that, the zip codes with, the highest concentrations of persons of color, highest concentrations of poverty, those were the ones that got the highest concentrations of PPP loans as measured by that kind of that per business measure. Now, on the flip side, if you look at the amount of dollars that's gone, you'll see that those south side zip codes, well, they were the ones getting mostly the smaller loans, while the north side zip codes were getting the larger loans. And so again, it's a nuanced story. It's very, it's not as cut and dry as saying that this is an equitable distribution of a federal asset or not, because there's a couple of ways to slice this up. And that's why, we posted a blog post titled The Tale of Two Tales, because there's really two stories here. If you look at the loans distributed as a rate of total businesses, well, you'll see that the top 20% of those zip codes, 70% Black populations, a 17% poverty rate, and an average household income. And remember, average household incomes tend to be higher than median household incomes, and an average household income of less than 70. If you do it by count, so just saying just where those loans went by zip code, a completely different story emerges. And so that's why I titled this slide A Tale of Two Tales, because once you really start slicing the data, the equity story, at least in this case, is a pretty nuanced one.
Yeah, and the majority of businesses in Metro Atlanta are on the northern side of the region. And we've done this, we've mapped it for years. We would love for more jobs and businesses to be located in the southern part of the region. A lot of our planning activities are focused on that. So this isn't a surprising result, and it really is this kind of tale of two things.
Yeah, and that's probably the equity story that we need to be talking about, is why are most of the businesses located on the northern part of the region and not the southern part of the region. But that's not the purpose of this particular analysis of the PPP loans.
Yeah, and so if you look at small business confidence, and Mike and I talk a lot about Raj Chetty's website because it was so focused on small businesses, small business revenue, and you are thinking about what they're thinking, and this is from Goldman Sachs and Axios Visuals again. Do you think your business is going to survive? And these numbers are from April to September, and it's holding at about 65%. But again, almost a third aren't sure if they're going to make it. And this is critical for us to understand, because we're looking at the impacts of the federal stimulus. We know compared to other countries, we did have a big stimulus package coming out of our federal government, but most businesses think they're going to make it, but really a sad share aren't sure or don't think they're going to make it, and that's going to feed some of the other slides we're about to click on. So let's keep going.
Yeah, and this is again just to just to, kind of drive home the point of how much small businesses have suffered, this is kind of an uninteresting visual because there's not a lot of range between the top and the bottom. I did that purposely because, at least, probably 7 in 10 businesses responded that they had a large or moderately negative effect from the pandemic. And so if you have 7 in 10 businesses that have took some sort of negative shock, that tells you the extent of the issue that we're dealing with. And this is as of September 5th. And so, this is, a fairly recent thing. And then, I just highlighted where Atlanta is. Atlanta's sort of in the bottom half of this. Now, the next slide, and again, I made this more complicated than it needed to be, but I did a ratio of businesses saying that they are decreasing hours versus those saying they are increasing hours. So any bar that's positive, that's going up, represents more businesses saying that they're decreasing hours. And here's Atlanta. So again, Atlanta's kind of in the bottom third, but it's still twice as many businesses. Let's say that value's 2. So that means that twice as many businesses are saying they're decreasing hours versus increasing hours. And again, this is as of the first week of September. All those PPP loan funds are probably already spent. And so it's going to be interesting to see if this trend of continuing to decrease hours is going to continue. My guess would be it would, because it doesn't seem that federal stimulus is coming down anytime soon. So
yeah, we want to acknowledge the Census Bureau did something they've never done before with these national surveys, these pulse surveys. So, I like to acknowledge the fact that they're doing these surveys. We would have never had this information before if they hadn't really taken up the mantle to try to build some survey methodologies where we could have these comparisons and really get some sentiment about how small business is doing in almost real time. So hard to look at, but grateful that we have this data to show you today. Let's go to the next slide. Okay, and so we're shifting gears a little bit because I thought everybody that's on this webinar would be interested now, 6 months out, really how are really space markets being impacted. And we're going to click quickly through these in the interest of time. Please go look at this in more detail. We pulled this from our CoStar license so that you could see how Metro Atlanta was actually doing with some comparison. So the short story is, and we're going to reiterate this at the end, is, you've got to look at the green, which is Metro Atlanta's vacancy rate, what the forecast is. So we've been holding, the vacancy rate is going up for our office market, much higher than the US vacancy rate. And, we were slow on deliveries and net absorption from like 15 to 19, had a big year, closing out 19 and early 20. And then you're going to see it bounce around a little bit in the forecast. So it takes some time to chew that down. Vacancy on the right, and of course, absorption and deliveries in millions of square feet on the left axis for our office market. Go ahead and click, Mike. And then how does that compare? This is a summary report from CoStar again. So New York, right now, before the pandemic and in this pandemic, the most office space under construction, the big winner really from the Amazon decision from a few years ago. They've been very strong at building more office space. And you have to kind of go down to see where Metro Atlanta is. And things that I'm paying attention to, obviously, is that an Austin and a Nashville and a Charlotte all right now have more office space under construction than Metro Atlanta. Let's keep going. And then if you look at that as a share of inventory, I could not show you this. Nashville has a relatively small office market. And so, of course, they're going to be leading the nation as a share of that construction. They were selected to have 5,000 actual office oriented Amazon jobs. And I think that's very much reflective in this. But these high-tech places like Austin and San Jose don't have the big office footprints of obviously New York, really dominating the share of construction as a share of the total inventory. Again, Atlanta just barely getting on the first side of this data. Keep going, Mike.
Yeah, this is looking at multifamily, and this is the kind of the same data that we're looking at. You'll see, kind of, in the multifamily market in the last 3-4 years, it's been kind of hot here. As we all know, we're adding lots and lots of new multifamily units. What CoStar is forecasting is that, well, yes, there's going to be necessarily a big decline in, the absorption rate and the net delivery rate over the next couple of years. And that's going to correspond with, higher vacancy rates. Just as people are, as people are trying to, stumble their way through the economic downturn that we have.
And industrial, a very similar pattern. Vacancy rate, they expect to be increasing here. But let's go ahead and click to the next slide. And you'll see, if you look at industrial space, Dallas under construction, and Inland Empire, Atlanta, Chicago, Houston, all mature markets, but a lot of space under construction. I think this is something I think is absolutely what you would expect. So we really have been leading nationally or of similarly sized metros in the amount of industrial space under construction. You hear that in these Amazon style announcements, but Amazon is building everywhere. But Dallas is like nobody else right now on industrial space.
All right, so now we're going to shift gears again and talk about housing, because we've been talking about housing for a long, long time, and we're all trying to get our arms around what impact the pandemic and the associated economic downturn is going to have on our housing markets, and specifically, what does that mean for, kind of these dispossessory actions called evictions? What does that mean for that space? Well, let's first just take a look at overall building activity. I mean, it's holding steady. Yeah, it's a little bit down this year compared to last year, compared to the year before, but it hasn't dropped off it hasn't dropped off a cliff yet. Now, what is dropping off the cliff, it hasn't dropped off it yet, is just the housing inventory. We have a very, very low inventory right now. And, this just goes back to our basic economics 101, law of supply and demand. If you have, low inventory, high demand, well, what does that mean, Mike?
Yeah, and so I felt like it would be interesting for you to recognize this as someone who likes to do woodworking, spends time in woodworking shops. I realized that lumber prices are really starting to take off. So I did a little bit of research and realized it's beyond taking off. The board foot price has gone up dramatically. And so when you do the research, what you realize is at the start of the pandemic, a lot of lumber mills just shut down. They thought there wouldn't be much demand for lumber in a recession, which wouldn't be irrational, except that with everybody home, there were lots of people that wanted to do construction projects, improve their houses, Mike Carnathan being one of them. And so prices have exploded. And for me to see that a standard 2x4 stud has gone to $5.75 a unit is incredible. And someone who can remember when they were under 50 cents as a kid, to see it at $5.75, that's a dramatic change. And what does that really mean? Well, the home builders research says that these current prices are adding about $16,000 to the price of a home. So clearly we want those lumber mills to get back up to full production, and hopefully these prices will come back down. But right now, in a period where we really need to be building as much housing as we can, housing costs are going to be higher, if nothing else, because the wood is going to cost builders a heck of a lot more money.
Yeah, and we entered this pandemic into as a seller's market. That's only strengthened because of these trends. Now let's get to the evictions part of this. And so what you're looking at is, number one, you're looking at a map with a lot of neon colors. The neon purples actually represent an index, and this is a need index that was developed by the Urban Institute. And it's really, what it's supposed to do is show you where, if you're going to prioritize rental assistance, which areas should you be prioritizing? And those are those areas in that kind of that neon purple and the violets. And again, if you look at any map that we've made over the past 20 years at the ARC, this map looks very familiar. In other words, the needs, yes, this is a rental assistance priority index, which means this is talking about needs in terms of housing, but you could replace housing with anything. This is just where, you know, the most need is, whether it's housing, whether it's income supports, whether it's health supports. And so you'll see that these areas entered the pandemic struggling. And then the little black dots on top of them are actual eviction filings that we've seen since March 16th. And so you'll see that in those areas of highest needs, well, that's obviously where the greatest number of evictions are going to occur. And so what that does is actually kind of validates this index as being somewhat predictive of where eviction filings and where the eviction, you know, I guess we're calling it a tsunami, where that eviction tsunami is really going to play out. And so here's that word. It's the coming tsunami of evictions. And the reason I'm continuing to use or overuse this analogy is, if you look at the trends, if you look at the actual number of eviction filings, and this is not, let me make sure that I'm getting this clear. These are not evictions. These are not evictions that have a legal judgment attached to them. These are eviction filings. So they have gone into the court process, but have been held up there. And so if you look at those filings, we've got about 9,700 since April. Last year at this time, during a good economy, we had about 62,000. So that means there's, you know, at least, and this would be the bottom number, because this is not a normal economy, but there's about 52,000 evictions that didn't happen because of the pandemic. And so when these protections, you know, the CDC just, you know, extended moratoria to the end of the year. So, you know, once all of these protections erodes, this is the tsunami we're talking about. And you're looking at a 52,000 number. That's going to be the low end if we don't start thinking about how to stave off this coming tide.
And we are going to go very quickly now in the interest of time, but our friend Jeff Koski, president of Bleakley Advisory Group, posted this, another CoStar report. And it's just that first indication. I hope you go read this article if you can. I think it's behind a firewall, but we're already starting to see people making economic decisions that's really showing them trying to be cost conscious in the way they're thinking about their own rental market. So evictions are on hold. If people can, they're driving up the cost of Class B rental properties because there's obviously more economic value for them if the resources are limited. So they're eschewing high-end units. So if you go look at the detail of the CoStar reports, you would find something similar.
And finally, we are going to go quickly through this because, you know, we always want to emphasize, yes, we've been talking about economy, we've been talking about topics of housing and health, but really it boils down to people. And so if you just look at the composition of the population of Metro Atlanta, and here we're actually talking about the 10-county Atlanta region, you'll see that, you know, the 10-county Atlanta region is majority person of color. So there's 44% white. That means it's 56% person of color. And so we wanted to emphasize that point because it's the persons of color that are taking a beating during this pandemic. And I'll let Mike Gay talk about this one.
Yeah, and I added this slide in this morning because I thought it's a good slide to get into a conversation about disparity. And you know, I read this headline in the Census Bureau email that the poverty rate was the lowest it has been since they started keeping this data in 1959 for Black people in the United States. But that poverty rate that they were saying is the lowest was still 18.8%. So almost 1 in 5 Black people in the United States living in poverty. And so if you look at that share, and the Census Bureau likes to say underrepresented and overrepresented. So of course, the Black population in the United States is overrepresented in this category of being in poverty. And so what's been happening is the Hispanic population in particular, their median household incomes have increased at a faster rate than Black households. So a Black household went up 14% since 2008. A Hispanic household went up 24%. So this idea that we're closing the gap, the lines are going down, but the fact is, comparing other races and ethnicities, the Black population in the United States really isn't getting that economic growth in the same way, and not closing that gap to get to a poverty rate similar to the white population. This is a huge challenge for all of us, because this is the easiest way we can explain that disparity and the inequality associated with it, and all the other things that feed into it, like job quality and housing choice and building equity. So we're going to go very fast through these slides coming up, but know that this is really at the heart of it.
Right, and so again, once again, and I'm taking Mike A's slide here, but you look at the job loss, and you'll see the disparities between Black, white. You see the disparities between, you know, by gender. You see it by education level. You see the data in the public health data. You'll see, you know, Black and brown persons are extremely more likely to contract COVID, and this is regardless of age. And then Mike, you want to chime
Yeah,
in?
and this is back to the Opportunity Insights website, and to fill out an idea earlier that, you know, high wage earners earning more than $60,000 a year, the net job decline as of August 1st here in Atlanta was -1%. For a low wage worker, even though I think we have this general understanding that low wage workers are the ones on the front lines of working, have still been laid off at a dramatically higher rate than high wage and middle wage workers. So that disparity is 16 percentage points compared to high wage workers. And again, people of color are disproportionately working in those low wage jobs to begin with. So they're being hit the hardest and the worst by this pandemic.
And, you know, in earlier slides, we showed you, you know, sector by sector, and we pointed out that, you know, the professional and technical sector, you know, actually saw a pretty sizable job loss year over year. But what's happening is it's not the high wage workers in that sector that's losing their jobs. It's the lower wage workers. And then, you know, one of the things that we've done with every presentation is kind of show, you know, where those unemployment insurance claims are concentrated. And listen, there's just no way to beat around this. The arts, entertainment, and recreation sector is just taking a beating. It is consistently the hardest hit sector, and we're just worried about the long-term sustainability of many of our arts organizations in Metro Atlanta, and we'll talk a little bit about that later on. And then there's a couple of maps. You know, we like to make maps. Here's just where low income employment is declining the most, kind of these darker areas. And you'll see, yes, it is concentrated in some of the lower income areas, but workers living in these high income areas or higher income areas, well, they're losing those low income jobs. And, you know, because rents are higher and because mortgages are higher in these areas anyway, they're likely to see, to need some sort of assistance to keep them in their homes. And then we've shown you this before. This is just looking at, you know, if you look at those neighborhoods that have the highest concentrations of threatened workers, and those are those working in that arts and entertainment industry or in the food and accommodation industry, well, you know, it's about 55% of the populations in these neighborhoods are Black populations compared to only about 15 to 18% white population. So again, this pandemic is targeting communities of color and its disparate impacts.
And if you're looking at businesses again, let your eyes move to the right towards the center and look at the black row that the number of businesses lost by Black owners during this pandemic is 41%. 41%.
And then, you know, we can continue to, you know, go down this path by looking at some of the census surveys that Mike alluded to earlier. But if, you know, the question was asked, have you experienced some sort of job loss since March? Well, if you're a Black worker, you are more likely to have said that, yes, you have lost employment. And it's, you know, it's about a 22 percentage point gap between Black workers and white workers.
And, you know, the same survey, if you're thinking about housing insecurity and you're asking someone whether their confidence level that they're going to make next month's rent, and for August 31st, the Hispanic response was 1 in 2 didn't think they could make next month's rent. A very high number for Black people as well, 32%. And of course, you can see that much lower number for white people.
Same thing for eviction filings. If you look at where those eviction filings have occurred, again, take the 100 highest census tracts for that eviction filing rate. Well, 82% of the population in those highest 100 census tracts are people of color versus 58% in all other tracts. So again, we see that disparity playing out in eviction filings as well.
And again, a similar pattern with food insecurity, right? So yeah. Actually, the highest reported number was someone saying other than the other race and ethnicities reported at 23% didn't have enough food to eat. And again, a lot of us have worked on food security issues in this, you know, this group of people who work regionally. And it has really been shocking how quickly food insecurity became an issue within just a few weeks of the pandemic really shutting everything down, that this was a real problem for us. And there's been a lot of great work done, but again, these numbers should be at 0%.
And again, just to keep hammering you over the head with this, there's another question about, you know, just how difficult is it paying bills? Is it somewhat or very difficult? And again, you see that disparity by race playing out, whereas Hispanic and Black populations are considerably more likely to say that they're having a very difficult or somewhat difficult time paying bills. And so that finally gets us to sort of our summing up page here. And, you know, just to kind of hammer this point home about, you know, who we're talking about. And you'll see that, you know, it's the same neighborhoods that have been historically disadvantaged. It's the same people who have been historically disadvantaged that are taking the brunt of the impact of this pandemic. And so, you know, we need to do better. We need to come out on the other side of this pandemic thinking long and hard about what we can do to reverse this, because we're not reversing it. These trends are actually accelerating during the pandemic.
And in summing up, we don't really want to read our bullet points. We hope you do. But I do want to focus on the last one. This is something Mike mentioned at the beginning, and it really speaks to the last round of slides, this idea of a K-shaped recovery.
Yeah. And so, earlier slides, you saw U-shaped, L-shaped, W-shaped, V-shaped, and this notion of a K-shape. And what that means is you have some of the population who's doing fine or even better, but then you have another segment of the population that is continuing to do worse. And that's this notion of a K-shape, where you have, relatively high income, white collar workers who are doing fine, who are actually saving more, who are actually going to come out of this, if not the same, maybe even a little bit better. But then you have a significant part of the population, and these are the populations that have already been struggling for generations. They're the ones taking the beating due to this pandemic. And so that's where that K-shaped recovery is. And so we need to keep our eyes on that and do everything we can to prevent that letter of recovery coming true.
Yeah.
So I think that's all we've got. Do we have time for questions, or did we talk through all the questions?
We have talked through some of them, and I want to be respectful of everybody's time. Click to the next slide, because the one thing we need to do is give a shout out to next week's webinar, same time, same place, and I think you would have a great time with our boss, Doug Hooker, the executive director, as he moderates this panel on an improv approach to planning. So I put the links into this slide as well. So if you go to the main webinar page, you can register for this as well. It should be a lot of fun. Should be a lot of fun. So with that, yeah, I'm looking at the questions right now, Mike. What's an acceptable testing rate? And it's really over 1 million per day in the U.S. Georgia is at about 34% as of if you look at the COVID exit strategy right now of what it should be to get to that idea that you're testing enough to really run the virus down. And so that testing rate isn't near where it needs to be for Georgia. So, over 300 million people in the U.S., you want to be testing over 1 million a day. That gives you a rough ratio, and they apply that as a per capita rate on most of the websites where they do the testing for testing rates. And that was from Susan Graff. Tim Young, love to read that name. Hope to see you soon, Tim Young. And he asked, I've asked our district for health folks about the decline in testing. Response, people are tired of testing. I'm not sure that's a question technically, but well said. I'm wondering why the testing has gone down. We have testing capacity in the state. And if you were to click and try to get a test now on any of the public health county level websites, it would spit you into a decision tree set of questions, and you would find it very easy to set up a time to get tested. So I don't disagree with the District 4 health people. Mike, anything to add on that?
No. I mean, yeah. People are tired of this. Just period. I mean, we're just tired.
Yeah. Myron Polster asks, how do you explain the low mortality rate in Georgia? Isn't it likely that much of Georgia's testing labs are picking up very low levels of infection compared to other states, meaning more positive cases than many other states? The second part of that question, I don't really know how to answer, but
I'm not sure either. I mean, that's Georgia's one explanation, and this is more of a rationalization than an explanation, but Georgia's population does skew a little bit younger than the nation as a whole. And so we have seen, an increase in younger adults contracting COVID. And as we do know, mortality rates are lower in younger age cohorts than higher age cohorts. So that's a rationalization. I don't really have a good answer for that question.
No. Tommy Pierce is splitting hairs with me. Tommy Pierce is the executive director of Neighborhood Nexus, works with Mike and I. Highlander is more fantasy than sci-fi, right? I'm not gonna bother
Do
to
we
answer
need to, do we need to do a poll?
that. Yeah, maybe we'll do a poll next time.
Ask
Oh,
for-
Shay, I miss you, Shay. Shay,
Oh,
hey,
yeah,
Mike
sure.
and Mike, it's Shay. I love this stuff. That's an easy one. Great. Read your name, Shay.
I'm looking at.
K-shaped recovery. Recent data found this to be the case for natural disaster recovery. This is from Sabrina and Mobility Services.
Yeah, I
And she
saw
even
that
posted a
article.
link to PBS.
Yep, I saw that article too, Sabrina. That's a good point.
Kate Little put up, recommend separating children from pets in terms of distractions. Might be more interesting, helpful to see how many parents doing homeschooling while also trying to work. Yeah, this is something, you know, with our staff at the ARC, watching people talk to us about how they're learning to parent and work at the same time is something that is critical for us to be understanding about. Mike, you do this. My children are older. We just are hoping they show up, but you physically have to do it as well.
Yeah. I mean, it's tough. Yeah. Any advice you got, Kate? Let's bring it on.
Oh, now here's the question from Carly Stevens.
Yeah.
Where should companies be investing or giving their philanthropic dollars?
That's a great question where there's no easy answer for that. Now, one thing that I can plug is, you know, Metro Atlanta leaders are coming together around this, you know, what I called earlier, the tsunami of evictions. I mean, we think that's because of the moratoria in place, because we're buying a little bit of time and have the ability now, because of these moratoria, to keep people in their homes. Rental assistance, keeping people in their homes, that's probably the thing that I would say where to invest your philanthropic dollars right now, because we have time to do something about that. But I mean, the need is so great. We need a little bit of everything.
Yep. Yeah, and this is something Catherine Lawler, the executive director of Archie, I think is very eloquent in talking about doing work upstream or doing work downstream. We're at that point in this crisis where we're having to do downstream work. Downstream work is trying to make sure people don't lose their homes, right? And we need to do that work now because that's where we are. I think the arts and entertainment industry, which is really something we should all value at a genetic level, is close to being in a crisis, because as much as any part of the economy, it's very hard for them to be open, right? To go into a theater right now, we check these theater numbers weekly. People don't feel safe. We talked about this, and I would love to see our arts and entertainment community survive this pandemic in a way that we can be proud of, and not just let it be the status quo of business decline, because we can't turn them back on right now, so they need help.
And there's a third Mike who has chimed in and thinks he's funny too. Mike Gerber asks the question, is there a statistically significant relationship between the length of the pandemic and the length of ARC data presentations? I'll leave that without comment, Mike Gerber.
Yeah, as always, Michael Gerber.
But there is also a great follow-up question from Carly about, you know, what about weighing the immediate needs like this or longer-term solutions like the Atlanta Wealth Building Initiative and other organizations like that. And that's, you know, exactly, yeah. I think that's exactly what Mike A was just talking about, is like, you know, yes, we have immediate needs, but if we don't address these systemic issues that are just being laid bare once again and develop longer term solutions on the other side of this, well, we've missed that opportunity.
As much as I dislike the word unprecedented now. I could not love more the phrase wealth building.
All right, well, I guess we have time for a couple more questions.
Yeah, let's see that one, Renee Bird Lewis. No, that's okay. Shay just gave a comment. These are mostly comments.
Yep.
Eric. Oh yeah, any number for the number of parents that probably quit to virtual school who may not return to the workforce.
No, not yet. And that's something that hopefully some of these surveys that the Census Bureau is doing, or some other type of survey, because I mean, everybody's doing these weekly or monthly surveys. And I think I saw something like that. But to give you an idea, now there is some actual research that was done pre-pandemic, and this is just childcare challenges in general. And this was done by years. And that report suggested that about 1 in 4 parents had to do something with something job related, either had to quit their job, reduce their hours, take a part-time job instead of a full-time job to address these childcare challenges. Now, I imagine that is probably accelerated and exaggerated during this pandemic, but no, we don't have any hard data on that today.
Okay, 4 o'clock. We have gone over, but I think I can speak for both of us. And when I say thank you so much for staying with us, ignore Michael Gerber's comments. We don't think there's a relationship between the length of this presentation and the length of the pandemic. But you know, we want everyone to get the best information we can provide. We know we're going to shoot to do this again in 2 months, another update in 2 months of the Mike and Mike show to really tell you how we've done, starting from.
Hopefully we'll have better news.
Hopefully we'll have better news. And again, I can't thank you enough for being with us. Tune in next week. Please sign up for the webinar with Dad's Garage. I think our staff, Melissa Roberts, has helped put this together. I couldn't be more excited about it. So please join us next week. And as always, we will continue to do webinars on Tuesdays. We've got a schedule running through the end of the year. I think you'll find some really fascinating things coming in the list on our website of future webinars. So again, one more time, thank you so much for hanging with us. If you have questions, please feel free to email us. I'll try to get Jared to send an email to everyone with a direct link again to the deck so that you can have it. Thanks again.
Thank you, guys.
Take care. Be safe. All right, I'm gonna